Welcome back to the deep dive. Today, we're really getting into something fascinating. It's where, well, macro history sort of crashes right into digital finance.
Yeah, it's a fundamental connection people are making more and more.
Absolutely. So our mission today is to take this really powerful theory, the fourth turning idea, and see how it maps onto Bitcoin's rise.
And specifically why people are calling Bitcoin this potential financial escape valve,
Yeah.
especially now with all the global, well, craziness.
Exactly. The sense of crisis, the distrust in old systems. We've pulled together quite a bit for this, the original Strauss and Howe theory,
Yeah,
obviously.
the foundational stuff.
Plus a lot of recent on-chain analysis, Glassnode, folks like that, and some pretty serious institutional reports. Think Fidelity, looking at the macro picture.
Right, trying to synthesize all these different angles. It's not just one thing telling the story.
It really isn't. And, putting all that together, connecting the dots between history and, like, real-time data, it takes a serious amount of work.
Oh, definitely. Time and resources.
So, because we really want to keep bringing you these clear, detailed insights, making sense of these complex crypto stories shaping things, we just wanted to ask a quick favor.
Yeah.
If you could take a second to like, subscribe, maybe hit that notification bell, it genuinely helps the channel a lot.
It really does boost things in the algorithm, helps more people find this stuff.
Totally. It lets us know we're on the right track and helps us keep focusing on this kind of quality, data-driven content for you. Your engagement is honestly key.
We appreciate it.
We really do. Okay, so let's dive in. Let's unpack this whole thing, starting with the history, the framework that kind of sets the stage.
Right.
For listeners who might have heard the term fourth turning thrown around but aren't, like, deeply familiar, what exactly is it, and why does it feel so relevant right now?
Okay, so it comes from this really compelling, sometimes kind of eerie generational theory by William Strauss and Neil Howe. The core idea is pretty straightforward, actually. They argue that societies, especially Anglo-American ones, tend to move through these predictable cycles. About 80 years long, roughly a long human lifespan.
80 years, okay. Like clockwork?
Almost. And within that big cycle, there are 4 distinct phases, or turnings. Each lasts about 20 years and has its own mood, its own social dynamic.
4 turnings within the 80 years. Got it. What are they?
Well, you start with a high. That's usually post-crisis. Institutions are strong. There's a lot of consensus, conformity maybe. Think post-World War II America.
Okay, a period of building and stability.
Exactly. Then comes the awakening. This is where people start questioning those strong institutions. Spiritual exploration, rebellion, think the 1960s counterculture.
Right, challenging the status quo.
Then follows the unraveling. Individualism runs high, institutions weaken, culture gets fragmented, trust starts to erode. Maybe like the 90s and early 2000s.
Okay, things starting to fray. And the last one.
That's the fourth turning. The crisis, this is the big one, the climax of the whole cycle.
So not just a recession or a tough patch. It's fundamental.
Absolutely fundamental. It's a period of, well, major crisis, existential threats. Society gets tested to its core, usually lasts about 20 years, like the other turnings.
And this is where society basically hits a hard reset.
That's the idea. Old institutions might crumble, new ones get forged in the fire. There's often a sense of collective danger, forcing people together for survival, pushing individualism aside for a while.
Can you give examples like previous fourth turnings in the U.S.?
Oh, yeah. The historical parallels are stark. Strauss and Howe point to the American Revolution era, then the Civil War era, and the most recent one.
Let me guess. The Great Depression and World War II.
Exactly. Spanning roughly from, say, 1929 to 1945. These aren't small events. They are epochs defined by breakdown, destruction, but also rebuilding and the creation of a new civic order.
Okay, so if the last one ended around 1945, add 80 years, that puts us right now.
Precisely in the window. The theory suggests a new crisis period likely kicked off around maybe the 2008 financial crisis and could run through the 2030s.
Wow. And the sources we looked at, they really lay out a specific case that we are in one now, that we've moved from that unraveling into the full-blown crisis.
Yeah, the diagnosis is pretty detailed.
What are the key signs they point to? What makes this era look like a fourth turning?
Well, the evidence, when you compile it from the reports, it just hits all the classic markers. First off, just look around. Widespread political instability, deep social fragmentation.
Yeah, you can't miss that. Polarization seems off the charts.
Right. It paralyzes governments, dissolves that sense of national unity, makes collective action, solving big problems almost impossible.
Good. What else?
Second, combine that political mess with just crushing financial stress
You
globally.
mean like government debt?
Exactly. The reports hammer this point home. Unprecedented sovereign debt levels. Not just the US, but everywhere. This isn't just numbers on a page. It restricts what governments can do. Well, massive debt makes it really hard to raise interest rates without triggering a crisis or making debt payments totally unaffordable. It puts central banks in a terrible bind, makes the whole financial system incredibly fragile.
So political gridlock, financial fragility.
Hmm.
What's the third piece?
The nature of disruption itself. In past turnings, maybe it was a new military tech or an economic crash was the main catalyst. Now,
Oh, bye.
AI is explicitly mentioned in the sources as a huge disruptive force. And it's not just, oh, some jobs might change. It's more fundamental.
Like questioning the value of human work itself.
Yeah, and intellectual property, creativity, layer that onto an already shaky economic structure. It's a massive accelerant. Think about how quickly mechanized warfare changed everything in the 1940s. AI could be doing that to the economy and society right now.
That's a powerful comparison. And there's a global dimension too, right? Geopolitics.
Oh, absolutely. Can't ignore that. We're clearly seeing a shift away from a US-dominated world towards something more multipolar, more friction.
Like rising tensions, challenges to the old order.
Exactly. Geopolitical tensions are high. The global governance structures built after World War II seem strained, maybe breaking down. So put it all together.
Political gridlock? Check. Severe financial stress? Check. Massively disruptive new tech? Check. Shifting global power? Check.
You've got all the ingredients. According to the theory, these are the hallmarks of a major crisis period, a time that demands some kind of fundamental societal transformation.
You know, when you lay it out like that, it stops feeling like some abstract academic theory.
It feels like Tuesday.
Right. It feels like the lived experience, the constant churn, the anxiety, the feeling that the systems we rely on are under serious pressure.
Straining at the seams.
Which makes me want to ask you, listening right now, does this resonate? Do you think we are living through a fourth turning crisis? If the theory holds, it means this instability isn't a blip. It's the baseline for a while.
And that feeling, that sense of systemic pressure, of institutional failure, that's exactly where Bitcoin starts to enter the conversation in a really serious way.
How so? Not just as like digital money.
Not just as digital money, but potentially as a structural necessity. Think about it. If the foundation's government, politics, and crucially finance start to buckle under all this debt and, importantly, distrust,
Yeah.
capital looks for a way out. It seeks alternatives, things that are, maybe immutable, outside the control of those failing systems.
Okay, that's a perfect transition. Let's get into section 2, why Bitcoin seems to thrive in these crisis narratives.
Yeah.
It almost feels like it was designed for a fourth turning, based on what the sources call the distrust hypothesis.
It really does. I mean, the timing of the white paper itself, right after the 2008 crash.
Yeah, Satoshi Nakamoto released it in direct response to seeing banks bailed out while ordinary people lost homes. That failure of institutions was baked in from the start.
Exactly. And the sources emphasize that this profound distrust in legacy systems is the primary fuel for Bitcoin's narrative appeal in times like these.
We're talking about things like central bank policies, right? Quantitative easing, money printing.
All of that. Policies that, over time, clearly erode the value of savings. Fiat debasement, plain and simple. Your money buys less tomorrow than it does today.
And there's this growing feeling, isn't there, that the institutions running the show are maybe prioritizing their own survival, bailing out banks, propping up markets over the financial well-being of regular citizens.
That perception is incredibly powerful. And what's really fascinating is how the generational piece slots right into this.
You mean millennials, Gen Z?
Yeah. Remember, a fourth turning is also supposed to be a generational reset. Think about the world millennials and Gen Z grew up in.
Post 9/11 security state, the 2008 crisis and its aftermath, massive student debt, stagnant wages for many.
Right. They inherited a world defined by surveillance, by seeing huge institutions get bailed out with seemingly no consequences while they face precarious futures. Their default setting towards centralized authority is often skeptical, to put it mildly.
So they're naturally more drawn to something decentralized, more crypto native, as they say.
It makes intuitive sense, doesn't it? They see Bitcoin, or at least the idea of Bitcoin, aligning with this needed societal and financial reset.
A system that's designed to be outside of government control.
Yep.
Immutable, censorship-resistant.
Exactly. For a generation looking at inheriting mountains of sovereign debt, watching their savings potentially inflate away, seeing inequality rise, Bitcoin can look like an escape hatch, a way out of a financial system, a social contract they feel they never really agreed to.
Okay, but let me push back here a bit. Based on the sources and just common sense, we're talking about a crisis defined by instability. How can something as wildly volatile as Bitcoin be seriously called a safe haven?
That's the million-dollar question, right? Or maybe the multi-trillion-dollar question.
Its price swings are notorious.
Yeah.
100% annual volatility isn't unusual. That seems like the opposite of preserving wealth.
It is, if you define risk in the traditional way. The sources tackle this head-on. They basically argue we need to redefine risk in a fourth-turning context.
Okay.
Traditionally, risk market volatility, price swings. But in a period of deep structural crisis, the biggest risk isn't necessarily your Bitcoin crashing 50%. The biggest risk might be sovereign risk.
Meaning the risk your government defaults, or your central bank loses control, or your currency just collapses.
Precisely. The risk of systemic failure in the legacy system. Bitcoin's volatility, yeah, it's high. That's partly price discovery in a market that's still relatively new and facing regulatory headwinds. But it carries zero sovereign risk. Its scarcity is mathematically guaranteed, not subject to political whims. So analysts like those at Fidelity argue that the volatility is the price you pay to hedge against the arguably much larger, potentially existential risk of fiat debasement or geopolitical asset seizure.
So the volatility is outside the system that might be collapsing.
That's the core argument. It's
Yeah.
a different kind of risk, potentially a preferable one when the alternative is watching your life savings evaporate due to inflation or capital controls.
That definitely reframes the calculation. And there's a historical parallel here too, right? This isn't just a theory about digital assets. We've seen something like this before.
We have. The sources draw a really clear line back to the 1970s.
After Nixon closed the gold window in '71?
Exactly. Suddenly the dollar wasn't backed by gold anymore. That decade was marked by runaway inflation, loss of faith in currencies, oil shocks. Sound familiar?
Yeah, a little too familiar. So what happened then?
What asset went absolutely parabolic? Gold. People fled paper assets that were losing value and piled into hard, finite money. Gold had a massive boom.
Okay, I see where this is going.
The thesis now is that Bitcoin is basically playing that same role, but for the 21st century, it's acting as the digital successor to gold in many ways.
So if the '70s gold rush was a reaction to that era's instability and currency debasement,
Then the Bitcoin acceleration we're seeing now, especially since 2020, is potentially the technologically enabled version of the same impulse. It's fulfilling that need for a non-sovereign hard asset hedge during a time of deep institutional turmoil and financial uncertainty.
and arguably it's better suited for a digital age, right? Easier to transfer, divide, verify.
All those things. More accessible globally, harder to confiscate physically. It fits the profile for the digital era.
Okay, this is where it gets really compelling, I think. Because it's not just a theory anymore. We need to look at the specific things happening now that are actually accelerating Bitcoin's adoption during this perceived crisis. It's not just a hedge on paper. Capital is moving.
Right. The sources break this down really well into sort of three converging forces, or pillars.
3 pillars driving adoption. What are they?
It's this convergence of, 1, inescapable macro pressures, 2, strategic institutional embrace, which is kind of ironic, and 3, an accelerating technological shift. It's the combination that creates this potential perfect storm for Bitcoin beyond just speculative cycles.
Okay, let's break those down. Pillar A, macroeconomic instability. We touched on this, but let's go deeper. It's not just general nervousness. The sources point to specific systemic issues, like the debt crisis.
Yeah, the debt is huge, particularly the U.S. debt to GDP ratio, which keeps getting highlighted. It's not just the number itself, but the policy implication.
Meaning the policy trap you mentioned.
Exactly. When debt is this high globally, governments and central banks are backed into a corner. They can't really raise interest rates significantly without potentially bankrupting themselves or crashing the economy.
So they're almost forced to keep monetary policy loose, keep printing money effectively.
That seems to be the path of least resistance, yeah. Print money to service the debt, inflate the debt away over time.
Yeah.
And when you look at the charts in these reports, they overlay the Bitcoin price against things like the U.S. debt to GDP ratio or the M2 money supply. And the correlation, especially since 2020, is kind of chilling. As the debt burden grows and policy options shrink, the appeal of a finite, non-debt-based asset like Bitcoin just structurally increases. It becomes like sovereign default insurance.
And we saw this play out so clearly during the pandemic response.
Yeah.
2020, 2021.
Textbook example, massive government spending, huge central bank balance sheet expansion globally, and what happened? Massive inflows into Bitcoin. Why?
Because trust in fiat plummeted. People saw the money printer go burr and understood, maybe for the first time viscerally, that it meant their savings would buy less. Inflation became real, not just theoretical.
Or precisely, the cost of monetary expansion became explicit and immediate. And this isn't just a domestic issue anymore. This instability is going global, affecting trade, reserves.
You mean the whole de-dollarization trend?
That's a critical piece of this macro pillar. As geopolitical lines get redrawn, U.S. versus China, Russia, the BRICS nations, expanding countries, are actively looking for ways to reduce their reliance on the U.S. dollar.
Why? Just politics.
Politics, but also financial warfare. They've seen how sanctions can weaponize the dollar system. If you're a nation potentially at odds with the U.S., holding massive dollar reserves starts to look like a liability, not an asset.
So if you want to trade internationally or hold reserves but not use the dollar system, what do you use?
That's the trillion-dollar question. What serves as neutral collateral? What's a reserve asset that isn't controlled by a geopolitical rival?
Gold, maybe.
Gold plays a role, sure. But moving large amounts of gold is cumbersome. Bitcoin, however,
Offers a potential neutral, non-sovereign settlement layer and store of value, something outside any single country's control.
Exactly. The potential implications for global reserve assets are enormous. It creates this vacuum that a globally accessible, politically neutral asset like Bitcoin could theoretically step into. It's an apolitical choice for countries wanting to bypass the existing system. That's a huge potential demand driver tied directly to global instability.
Okay, that macro picture is pretty stark. Let's shift to Pillar B, institutional adoption and accumulation. This feels like the big paradox. Bitcoin's rise is fueled by distrust in institutions.
And yet it's those very institutions that are now piling in and accelerating the trend. It's fascinating.
Historically, Bitcoin was mostly retail investors, right?
Yeah.
Tech enthusiasts, libertarians.
Yeah, for the first decade, pretty much. But the game changed dramatically, especially in the last few years. The institutional floodgates didn't just crack open, they blew open.
How? What was the main mechanism?
The most obvious one, spot Bitcoin ETFs, especially in the US, but also other major markets.
Why are ETFs such a big deal?
Because they provide a regulated, familiar, easy way for huge pools of capital to get exposure. Think pension funds, endowments, wealth managers managing trillions of dollars. Before ETFs, it was complicated, risky from a compliance or custody perspective for them to hold Bitcoin directly.
So the ETFs are like regulated on-ramps onto the Bitcoin highway for Wall Street money.
Perfect analogy. It moves the capital flows from the sometimes clunky, sometimes sketchy crypto exchange world onto the super efficient, trusted rails of traditional finance. That means potentially sustained mechanical buying pressure that's less tied to retail sentiment or hype cycles.
But it's not just passive index investing through ETFs, is it? We're also seeing companies actively choosing to hold Bitcoin on their balance sheets.
Right. Corporate treasury adoption is the next layer, and the prime example everyone points to is MicroStrategy.
Under Michael Saylor, what they did was pretty radical.
Totally radical at the time. Saylor basically looked at the macro environment, the inflation, the money printing, and decided holding large amounts of cash on the company's balance sheet was actually the risky move. The cash was guaranteed to lose purchasing power.
So he converted their treasury reserves into Bitcoin as an inflation hedge.
As an inflation hedge, yes, but he framed it even more profoundly. He talks about Bitcoin as a kind of thermodynamic energy battery, storing monetary energy, future purchasing power, outside the leaky fiat system. It was an accounting strategy, a wealth preservation strategy, based on a deep conviction about fiat failure during what he likely saw as a fourth turning style crisis.
And that strategy, while controversial, has been hugely influential, hasn't it? Other companies started looking at it.
It definitely put the idea on the map for corporate treasurers globally. Even if they didn't go all in like MicroStrategy, it forced them to consider Bitcoin as a legitimate treasury asset, not just a speculative punt.
Okay, so we have ETFs bringing in passive institutional money, corporations actively buying. What about governments themselves? Sovereign adoption.
That's the bleeding edge. And the main example here is El Salvador.
Making Bitcoin legal tender. That seemed like a huge leap.
Huge. And the sources frame this not just as, oh, cool new tech, They see it as a deliberate sovereignty play during global instability.
What does that mean practically for a small nation like El Salvador?
Well, for smaller countries, especially those heavily reliant on remittances from citizens working abroad, or those struggling with debt burdens imposed by institutions like the IMF or World Bank,
Yeah.
adopting Bitcoin is an attempt to gain some independence, to decouple, even partially, from the dollar system and its associated controls and vulnerabilities.
How does it help with remittances?
Remittances often make up a huge chunk of GDP for countries like El Salvador. Using Bitcoin and the Lightning Network can potentially bypass the high fees charged by traditional money transfer companies like Western Union. More money actually reaches families.
And the sovereignty part.
By adopting and holding a non-sovereign currency like Bitcoin, they're trying to assert financial independence. Reduce reliance on external aid that often comes with strings-attached debt conditionalities, political pressure. It's a strategic bet on insulating their economy from global financial shocks and outside interference, especially during a time when global alliances are shifting. It's about controlling their own financial destiny.
Okay, that's a powerful set of drivers under Pillar B. What's the final piece, Pillar C? The technological shift.
Right. This pillar views Bitcoin not just as a reaction against the old system, but as a fundamental building block for the new digital financial system.
Connecting it to things like AI and tokenization.
Exactly. The argument goes, if the world is becoming increasingly digital, automated commerce, AI agents making transactions, massive data flows, what kind of money do you need at the base layer?
Something.
Yeah.
Trustworthy, secure, predictable.
Precisely. You need a digital financial base layer that is absolutely secure, totally immutable, and reliably finite. Bitcoin, the argument goes, provides that. It's the hard money anchor in a potential future sea of digital chaos and infinite digital creation.
How does AI specifically play into this? Why would AI need Bitcoin?
Think about what AI needs to function reliably in commerce. AI systems executing smart contracts, transferring value, managing assets, they need to operate on data they can trust implicitly, data that can't be changed or censored.
Okay, verifiable, unchangeable ledgers.
Exactly. The rise of sophisticated AI actually increases the demand for censorship resistance and verifiable digital scarcity. AI models processing financial data need to trust the rails they run on. Bitcoin's blockchain, with its proven security, decentralization, and that hard cap of 21 million coins, offers unique trust properties.
And tokenization. That's the idea of putting real-world assets on a blockchain, right?
Yeah, representing things like stocks, bonds, real estate, commodities as digital tokens. We're talking potentially hundreds of trillions of dollars in value moving on to blockchains eventually.
So where does Bitcoin fit in there?
Well, if you're going to tokenize everything, you need a reliable, neutral, decentralized measuring stick, a standard of value against which all these diverse digital assets can be priced and settled.
Like a digital gold standard.
That's exactly the analogy the sources use. Bitcoin potentially serves as that ultimate digital reserve asset, the digital gold, providing the stability and trust needed for this next generation financial infrastructure, where value transfer might be increasingly handled by AI and automated systems.
Okay, that's a comprehensive look at the structural forces, the macro instability, the institutional adoption, the tech shift. It paints a very compelling picture. But let's bring it down to the ground level. What does this whole narrative actually mean for people investing or trading in the market right now? What are the practical takeaways?
Right. How does this translate into market dynamics? It really depends on your time horizon and your level of conviction in this whole thesis.
Okay, let's start with the long-term believers, the HO dealers, as they're called.
For them, the thesis is pretty clear and structural. They're looking at these forces, the debt, the distrust, the generational shift, the institutional flows, and they see them as long-term, likely irreversible trends, not just a temporary blip.
So they expect Bitcoin adoption to just keep accelerating cycle after cycle, driven by these underlying crises.
That's the core belief. Their strategy isn't market timing, it's accumulation. Buy and hold through the volatility, especially during periods of instability, because they believe the fundamental value proposition as an escape valve only grows stronger over time. And we see evidence of this in the on-chain data.
We'll get to the data in a second.
Yeah.
What about shorter-term traders? How does this narrative impact them?
For traders, the expectation is probably more intense volatility, but with significant asymmetric upside potential.
Meaning bigger swings, but potentially much bigger rewards if the thesis plays out.
Exactly. As the market narrative potentially shifts from seeing Bitcoin as just another risky alt asset towards viewing it as a genuine safe haven against sovereign risk, you'd expect price movements to become much sharper.
Or reactive to macro news.
Highly reactive. Think about it.
Think
If
about it.
there's a major global banking scare or a sovereign debt crisis flares up somewhere, if this thesis holds, you'd expect to see capital immediately flow into Bitcoin as an exit. That translates into potentially explosive price surges, validating its role in real time.
Okay. And what about the rest of the crypto world, the altcoins, the broader Web3 ecosystem?
Yeah.
If Bitcoin becomes the crisis anchor, what happens to everything else?
That's where the sources sound a pretty strong note of caution.
Oh, how so?
Look, altcoin markets thrive on liquidity and risk appetite. If
Hmm.
Bitcoin is accelerating primarily because capital is fleeing risk in the traditional system,
Yeah.
yes, some of that liquidity might spill over into altcoins, driving cycles there too. But the warning is that the risk-reward calculation gets much, much steeper for alts in a true crisis scenario. During periods of extreme fear and uncertainty, capital tends to consolidate. It flies to perceived safety and quality.
So money might flow out of riskier altcoins and into Bitcoin if things get really bad.
That's the risk. Bitcoin, being the oldest, most secure, most decentralized network, is the natural shelling point for safety within the crypto space. Altcoins, while offering potentially higher growth, also carry much higher risks. Liquidity risk, security vulnerabilities, centralization risks. They're less reliable as hedges and could see sharp capital flight if a deep crisis hits. The divergence between Bitcoin and alts could become much more pronounced.
That makes sense. Okay, let's get into that on-chain data you mentioned. Moving from the narrative to the hard evidence, what metrics actually support the idea that smart money, long-term capital, is treating Bitcoin as a crisis hedge right now?
There are a few key charts the sources consistently point to. We can start with something pretty basic, Bitcoin dominance.
That's just Bitcoin's market cap relative to the total crypto market cap, right?
Exactly. And the key observation is what happens during periods of fear or major market uncertainty.
What happened?
Bitcoin dominance tends to spike sharply. When bad macro news hits, or there's a major blow-up in the crypto space itself, you often see capital rotate out of the more speculative altcoins and consolidate into Bitcoin.
So its market share grows when fear is high, reinforcing that safe harbor idea within crypto.
Precisely. It acts as the flight to safety asset within the digital asset ecosystem itself.
Okay, what else? You mentioned HODL waves earlier.
Ah, yes, HODL waves. These are fascinating. They basically visualize how long different portions of the Bitcoin supply have been held without moving.
So you can see if people are panic selling or holding tight.
Exactly. It paints a really clear picture of investor conviction. It separates the short-term traders, the weak hands, from the long-term believers, the strong hands.
And what are the HODL waves showing now, especially regarding those long-term holders?
This is where the data gets really compelling, according to the reports. Long-term holders, or LTHs, typically defined as wallets that haven't moved their Bitcoin for at least 155 days, are holding a record amount of the total supply.
An all-time high, even with all the recent volatility and crisis talk.
Yes. The supply held by these long-term, high-conviction players is at or near all-time highs. What does that tell you?
It tells you they're not selling. They're accumulating. They believe in the long-term story, regardless of short-term price swings. They see instability as a reason to buy more, not sell.
That's the signal. This persistent accumulation by LTHs is crucial. It means that during this period of perceived crisis and accelerating institutional interest, the actual liquid supply of Bitcoin available to buy on exchanges is constantly shrinking. It's being locked away by strong hands.
Which sets up a potential supply shock down the road. If demand keeps growing from ETFs, institutions, maybe even sovereigns.
Exactly. Basic supply and demand. If supply is increasingly illiquid and locked up, and demand ramps up due to these macro and institutional drivers, well, that's a recipe for significant price appreciation. This accumulation during instability is a core piece of evidence for the escape of valve thesis.
Okay, one more data point. The correlation between Bitcoin and gold. How is that playing out?
This is where you see the digital gold narrative potentially becoming reality. The sources point to correlation charts showing a clear generational substitution effect.
Meaning younger investors are choosing Bitcoin instead of gold as their crisis hedge.
Increasingly, yes. While gold remains the traditional non-sovereign hedge, especially for older demographics and central banks, Bitcoin is steadily eating into that role, particularly among younger, more tech-savvy cohorts and forward-looking funds.
So the data shows Bitcoin behaving more like gold during periods of stress and potentially replacing it in portfolios over time.
That's the trend these charts suggest. It validates the idea that Bitcoin isn't just another tech stock. It's starting to fulfill that ancient role of hard, non-sovereign money, just in a digital form suited for this century's crises.
Okay, let's synthesize all of this. We've got this powerful historical theory, the fourth turning, predicting a major structural crisis. We have deep generational distrust, creating the demand for an alternative. We have global debt and macro instability creating the urgent need for a financial escape. We have institutions, ironically, building the regulated on-ramps for capital to flow in.
Right.
And then we have the on-chain data showing that long-term, serious holders are actually accumulating through the chaos, locking up supply.
It's a potent convergence of factors.
It really suggests something more durable, more structural is happening than just another crypto bull run based on hype.
Yeah.
Which brings us back to that fundamental question from the source material, the one we really want you, the listener, to chew on. Is Bitcoin truly cementing its place as digital gold? Is it becoming that essential hedge against systemic crisis and fiat failure? Or is this all just a very compelling story, a speculative bubble inflated by a clever narrative that happens to fit the times?
It's the key question.
The convergence of all these factors, the theory, the sentiment, the macro pressure, the institutional flows, the on-chain evidence, it certainly makes a strong case that Bitcoin's role is evolving rapidly. From maybe an alternative curiosity to something feeling increasingly like a financial necessity for navigating what's ahead.
A profound shift, if true.
So let's wrap this up. What does it all mean? We started with this idea of the fourth candle matter, turning this generational crisis marked by deep distrust, financial instability, all amplified by tech changes.
Right, the historical framework.
And our deep dive suggests that this exact environment, this perfect storm of instability and skepticism towards the old ways, it creates incredibly fertile ground for something like Bitcoin, something decentralized, provably finite, outside the control of the institutions people are losing faith in.
Yeah, the conclusion you draw from synthesizing these sources feels pretty powerful, almost unavoidable. If you accept the premise that we are indeed in, or entering, a fourth turning style crisis era,
which feels increasingly plausible,
then Bitcoin seems uniquely positioned. It becomes a crucial, maybe even mandatory, financial escape valve, a potential destination for global capital fleeing instability and seeking preservation outside the traditional system.
And it's not just a fringe idea anymore. The speed of institutionalization changes everything.
Totally. The ETFs providing deep, regulated liquidity, sovereign nations like El Salvador giving it political validation. It signals a shift from Bitcoin being an experiment to being a seriously considered mechanism for navigating this global reset we seem to be in.
Which leaves us with one last really provocative thought to end on. It's kind of hinted at in the sources, this tension between adoption and control. If this institutional and sovereign adoption keeps accelerating, driven by the ongoing crisis, what happens next? What kind of conflicts, or maybe even weird collaborations, emerge between the old world of nation-states and this new world of decentralized money?
That's the big unknown, isn't it? When an asset shifts from being a fringe hedge to potentially becoming a matter of national sovereignty.
Like a way for countries to bypass sanctions or reduce reliance on the dollar.
Exactly. Or even for institutions to hedge against their own government's policies. The regulatory implications become massive and incredibly complex.
Do the established powers try to co-opt it, embrace it strategically to navigate their own debt problems or geopolitical rivalries?
Or do they see it as an existential threat to their monetary control and redouble efforts to regulate, restrict, or even suppress it?
The outcome of this fourth turning, whether it's a managed transition or something more chaotic, it might actually hinge on that question.
Can the state ultimately coexist with decentralized money systems that offer an exit? Or is confrontation inevitable? That feels like the macro question hanging over the next decade.
A perfect and slightly unsettling place to leave our deep dive for today. Thank you so much for taking this journey with us, exploring this collision point between generational history, macroeconomics, and the future of finance.
Fascinating stuff.
Absolutely. We'll catch you on the next deep dive.